You might have noticed a strange disconnect lately. We keep hearing that inflation is cooling off, and the central bank is finally talking about cutting rates. Yet, when buying a house, getting a car loan, or securing business funding, the pressure hasn't let up. Financial conditions are still brutally tight. If you turn on traditional financial media, everyone is waiting for Jerome Powell to save the day. They hyper-analyze every press conference, assuming the Federal Reserve holds the master switch to the economy. The Federal Reserve doesn't control the entire machine. What they actually manage is the short-term overnight borrowing rate. The interest banks charge each other. That is a very specific, limited lever. Look at this chart mapping a standard yield curve. On the left side, you have that short-term lever, which the Fed directly controls. But on the right side, the 10-year, 20-year, and 30-year Treasury yields operate independently. These long-term rates actually dictate real-world borrowing costs. Waiting for policymakers in Washington to fix the economy misses the point. That long side of the curve is driven entirely by the raw supply and demand of the global bond market. The United States government runs a massive annual deficit, which means the Treasury has to issue trillions of dollars in new debt every single year just to keep the lights on. To issue that much debt without interest rates spiraling, you need someone on the other side of the trade. You need an enormous, continuous influx of buyers willing to absorb those bonds. For the last 3 decades, the most consistent, price-insensitive buyer absorbing that massive supply of American debt wasn't an American institution. America's appetite for credit has long relied on a silent partner across the Pacific, a relationship that kept the global supply of dollars flowing without most of the public ever noticing. To understand how this works, we have to rewind to 1990s Japan. After a massive real estate and equity collapse, the Japanese economy entered the lost decades, a 30-year period of stagnant growth, zero inflation, and frozen wages. Out of options, the Bank of Japan introduced a drastic countermeasure called yield curve control. They essentially superglued their domestic interest rates to the floor, aggressively capping long-term bond yields at exactly 0%. Because domestic bonds paid nothing, investors borrowed yen at near zero interest, converted to dollars, and bought U.S. treasuries yielding 4%. They pocketed the difference, the yen carry trade. This expanded into the trillions, flowing outward to buy tech stocks, real estate, and emerging markets. This simple math equation accidentally turned Japan into the world's ATM. They became the primary source of global liquidity, providing the financial duct tape that held international markets together. In 2024, that equation broke. The Bank of Japan permanently ended its yield curve control policy and, for the first time in 17 years, raised interest rates. When Japanese yields rise, the mechanics of the carry trade fail immediately. Borrowing yen instantly becomes more expensive, the cost to hedge against currency risk shoots up, and that guaranteed profit spread vanishes. The global markets immediately panicked following the rate hike decision. The S&P 500 dropped 6%, and Japan's Nikkei 225 plummeted over 12% in a single day, its worst crash since 1987. The capital flows reversed. Decades of outward investment started flooding back to domestic Japanese markets, a violent withdrawal of capital known as repatriation. The cheapest source of global liquidity for the past 30 years has dried up. The United States' largest creditor has rewritten the terms of its investment, taking the era of free money along with it. Which brings us back to the U.S. bond market. If one of the largest, most consistent buyers of United States debt steps away, the Treasury has only one option to attract new buyers. They have to offer higher yields. This chart illustrates exactly what happens next, a steepening yield curve. Even if the central bank lowers short-term rates and the left side drops, the right side, the long-term borrowing costs, remains rigidly anchored in place because supply is outpacing demand. The bond market establishes the risk-free rate of return. It acts as the baseline gravity that determines the valuation of every other asset class. That puts the Federal Reserve in a bind. They can slash their overnight rate to zero, but if global demand for long-term bonds evaporates, American borrowing costs simply will not fall. When long-term yields stay elevated, analysts have to discount future corporate cash flows using that higher baseline. The present value of those future earnings decreases, forcing stock valuations to compress even if a company's actual earnings are fine. The housing market locks up for the exact same reason. 30-year mortgage rates are directly anchored to the 10-year Treasury yield. If demand for those treasuries weakens, mortgage rates stay high and home affordability remains strained, regardless of what the Fed announces. And it trickles down into corporate credit. Elevated borrowing costs kill risk appetite. They halt business expansion, throttle deal flow, and freeze the capital that companies rely on to operate. The unwinding of this 30-year foreign subsidy is now resetting the foundation of the bond market. While the world watches for signals from Washington, this quiet reversal of capital will dictate the true price of everything from a mortgage to a tech stock.